they are the preeminent economic power in the world. That may still be the case in the upcoming years and quarters, but it does bring doubt when you have to purchase your own debt in such large amounts in order to bring about high bond prices or low yields. And low yields are actually through the ZIRP policy that the Fed has instituted. ZIRP is actually starving the banks and creating significant distortions in price discovery throughout several markets, bond markets, equity markets, and all the related markets. So it's a big mess. And it's a mess that I think if we would have swallowed our medicine back in 2007, 2008, we could have avoided this significant price distortion, which will not end happily.
So, yes, one of the markets that's being distorted, of course, is the price of oil, right? Because as the Fed is monetizing its own debt, buying its own debt, this is frightening people to run into places like oil, because they realize that the Fed is playing an incredibly risky game, correct?
This is the way it appears. You know, the price of oil is going up without an apparent commensurate increase in demand. And when you have an increase in price without an increase in demand, there's something askew. And oil has gone significantly up. I put gas in my car last night, $4.75 a gallon. You know, that's excessive. You know, it makes me want to walk.
Right, but Reggie, people are blaming Barack Obama for the price of gas. Why aren't they pointing the finger at the Federal Reserve? The Federal Reserve and the Treasury are printing money that's debasing the value of the currency. That's why the price of gas is going up. Now, will the release of any oil from the Strategic Reserve have any effect on the money printing that's going on?
Well, I doubt it was going to have an effect on the money printing. I think it's the other way around. As you said, the money printing most likely has an effect on oil prices. The release of the reserve, and I'm not an oil expert, you know, just as a disclaimer, but I am very good at common sense and valuation. The release of oil reserve will cause a trading drop in prices temporarily, but the other factors in play may cause oil prices to rise again. We've been through this scenario before in 2008, and remember, the significant spike in oil is what many blamed on as a straw that broke the camel's back, that caused the equity markets to collect in general, and then consequently the credit markets. It's quite possible because I believe the recovery that you see in the mainstream media is a full recovery. The numbers, they say, are going up, but if you take a look at the numbers and adjust for retroactive adjustments, you have misses. You have a roughly 57 to 60% of misses of the economic numbers that were released yesterday and throughout the last week. You know, that's not a recovery. That's actually the opposite.
Right, and going back to that 2008 period when oil was at 147 or so, of course, was the instigating economic factor that caused the revolution in Egypt and across the entire region. So high prices tend to stoke revolution, whether it's the French Revolution, the Egyptian Revolution, or most of the revolutions throughout history. Now, the U.S. federal government has recently taken over much of the student loan market. That market now has passed $1 trillion, according to Fitch, and yet more than 25% of student loans are delinquent. Is this the next subprime disaster, Reggie Middleton?
Well, it's the next mispriced credit disaster. Again, the term subprime is a term that the mainstream media latched onto because it was easy, it was convenient. But, you know, when the mortgage market collapsed, it had nothing to do with subprime lending. Subprime lending was the first to go because the subprime borrowers had the weakest finances. But the reason why the market collapsed was a lack of prudent underwriting. So it was basically giving money away for free. The student loan market is basically the same thing. Number one, you have rampant inflation in education pricing. Okay, rampant inflation. There's no reason for tuition costs to go up as far and as high as they're going. It's not as if the quality and the quantity of education has risen in the commensurate basis with the cost of tuition. So you have the inflation combined with the fact that you have an entire industry based upon lending towards those who are chasing inflated inflation, combined with the fact that the underwriting is a joke to begin with. Basically, everybody who wants a loan gets a loan, combined with the fact that you have rampant unemployment among the youth. So you combine rampant unemployment with very, very slack underwriting, with the pricing of the product being borrowed for to be purchased, shooting up like, you know, firecrackers, and it's a recipe for disaster. So, with all due respect, of course, we're still saying subprime. Let's say slack credit underwriting bubble come boom and bust.
Right, serial bubble blowing, what the hallmark of the Bernanke Greenspan era. Now, we recently discussed a headline, J.P. Morgan claims #1 for government debt after Jefferson County. The article notes that despite the role in 2 of the biggest scandals in the history of U.S. public finance, the company is still the biggest player in municipal finance. Why are glorified bucket shops like J.P. Morgan, Bank of America, Goldman Sachs allowed to continue to operate in such a capacity? Reggie Middleton.
Well, it's multifold. There's not a single reason, so I'll give you my opinion, which I'm going to couch as fact, but let's say it's my opinion in case somebody disagrees with me. Fact. But you have marketing. For some reason, a lot of the consumers of the services of the big banks are more ignorant, in my opinion, than they should be, or less knowledgeable. They believe that you have to be bigger to be better, and that's just not the case. If you take a look at the research on my blog, I ran circles around all the big banks for 5 years running. Their janitorial expenses are larger than my research staff budget. So how is it I'm able to run circles around them? It's a conflict of interest that drives them, which prevents them from outperforming, such as the most recent New York Times editorial from the ex-Goldman employee, made clear. And since I've been making it clear on my blog for a while. So you have the ignorance of the consumers of the product, thinking that if you go to the white shoe, big name investment banks, we'll get a better deal, combined with the fact that these banks have to outperform. Almost all of them are public companies now. They're no longer private partnerships. So they have to go quarter by quarter. They can't plan years ahead like they used to as their private partnerships. They have to impress quarter by quarter. In order to outperform everybody else quarter by quarter, you have to take advantage of your clients. It's a must. If you don't take advantage of your clients, the only way to outperform is over a medium to a long term. But to outperform quarter by quarter, that money, that performance has to be extracted from somewhere, and it's usually extracted from the clients, the same clients we're supposed to be serving. Okay. In addition, you have entities like J.P. Morgan, but to a much greater extent, Goldman Sachs, who have in total put, I'd say, at least billions of dollars of capital into lobbying. You lobby the government is your client, you're now bonded with your client in a way that might not facilitate the best possible outcome of a capital transaction. I go and buy something from you, but I lobby your bosses to give me a better deal, so I get you to pay more for less services. That catch-22 allows for all types of financial shenanigans to happen, and potential raping of the client, such as the Jefferson County deal, such as many of Goldman Sachs clients and J.P. Morgan clients have found out time and time again. The way to break that is to limit the effect of lobbying and limit the network effect of having so many ex-bankers entrenched within government. They're not the only ones that can count. And if you take a look at the performance of investment banks from 2007 to present, it just seems like they seem possibly to be the only ones that cannot count. That's not being the case, and it's an exaggeration, but hopefully I get the point across. There needs to be more diversification in government, and there needs to be a greater acceptance of intellectual capacity from outside of the banking industry, particularly since the government purchased so much in terms of services from the banking industry.
That's right. Goldman Sachs clients are just collateral damage while the firm is busy blowing up the economy. Let's talk about Mark Zuckerberg, CEO of Facebook. The company's going public, $100 billion or so. He maintains 56.9% of the post-IPO voting shares. Unprecedented. Your thoughts on this IPO?
Smart man, obviously very persuasive, or has a very large gun, one of the two, but good for him, kudos. But what's good for him is not good for the shareholders. I can't see myself voluntarily giving money to a company in exchange for stock where I have no say-so in what the company does. With over 56% ownership of the voting shares, he controls the company. He seems like a very intelligent guy. I have nothing against him. As a matter of fact, if I was him, I'd love to have control of a multi-billion-dollar social networking company as well. But if you take a look at his track record, okay, has he ever ran a public company before? No. Has he ever ran a company at this size before with a proven track record of success? Some would say yes, but how old is Facebook? Does he have any competition? Significant competition. As a matter of fact, some of the most powerful internet and media companies in the world are gunning for him. Okay, if you combine all that, is it an unnecessary risk to concentrate so much power into one person without a successful track record? Now, I'm not saying you need a successful track record to succeed, but it definitely helps. But combine that with the fact of the pricing, Facebook is outrageously overvalued. Outrageously. Best case scenario, the best case scenario possible, they're still overvalued by many billions of dollars. And that's the best case scenario. You know, when was the last time the absolute best case scenario came to play? You know, if it does come to play and something goes wrong, well, he has say-so. He's the CEO, period. He's also the owner of the vast majority of the voting shop. So if you didn't have the glamour marketing machine, otherwise known as Goldman Sachs et al. And the rest of Southside Wall Street, and you took a look at this as a simple business, like a friend of yours came up and said, well, I want you to invest in my business, but I'm going to have total say-so of what happens in the business. I'll sell you the stock, but all you get is the financial returns. You have no say-so on what happens. I'm competing against some of those powerful companies in the world, and I don't have much experience at this, but I've grown very fast, even though my growth has slowed significantly up till now, and let me have $100 billion. No problem, here it goes, right? Unlikely. But, with the, again, the glamour of bigger is better, Goldman et al., Morgan Stanley, JP Morgan, etc., marketing the stock, they've created such a buzz that fundamentals and common sense have actually gone by the wayside.
Right. Well, corporate governance suggests that this would be illegal as recently as 20 years ago. So it shows you how the laws have changed over the past 20 years for something as blatantly illegal as this in terms of corporate governance to go ahead. All right, Reggie Middleton, thanks so much for being on the Keiser Report.
Okay, you're very, very welcome. I look forward to coming back again.
All right. Thanks. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Reggie Middleton, of the infamous boombustblog.com. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.